Hello everyone, welcome back to Concierge CPA. I am Juliet, and today we're ready to begin our journey into financial records. We're going to talk about where it all begins, in the T account. In the previous videos, we learned about all the rules of debits and credits. We learned about the double entry system concept, and we took a deep dive into the financial equation. We are now ready to begin our journey into the financial records and where it all begins. How do transactions get into the general ledger? As I said, it all begins with the T account. If you haven't watched any of my previous videos, don't worry. I will summarize everything as we go along, and I will also leave some links in the description below. A T account is nothing more than just a graphical representation of every single account in the ledger. So there is a T for every account. What are the account categories? Remember the accounting equation: assets equals liabilities plus owner's equity. Assets could be things like cash, accounts receivable, inventory, equipment, and so on. Liabilities could be accounts payable, taxes payable, and wages payable. Owner's equity includes contributions by the owner to the business, dividends, which is payments to the owners, and retained earnings. Retained earnings is the earnings of the business over time. So if we break it out even more, it is composed of revenue minus expenses. And here it is, a little bit cleaner. So how does the T account work, and how does it help you remember the rules of debits and credits? Imagine that the vertical line is an account. So in this case, we're going to say it's cash. And the horizontal line separates the left from the right. In the previous videos, we learned that debit on the left and credits on the right. Cash is an asset account, so it means that it is in the left-hand side of the accounting equation, which means that debits increase the account and credits decrease the account. So remember the rules. Debits are always on the left and credits always on the right. And this is always true, whether it is an asset account, a liability account, or an account under the owner's equity. But what if the account is a liability account? So let's take, for example, accounts payable. This is an account under a liability, which is on the right-hand side of the accounting equation. The rules of debits and credits still hold. The debits go on the left and the credits go on the right. However, the difference is, for liabilities and owner equities accounts, these accounts are decreased by debits and increased by credits. Well, there is two exceptions to this rule for two accounts that are on the right-hand side of the accounting equation, and that would be for dividends and expenses. These two accounts are under owner's equity. Dividends decreases owner's equity, but they are increased by debits. Expenses are also increased by debits and decreased by credits. This will become a lot clearer with an example. Let's say you start your own business and you contribute $1,000 cash. Your cash goes up by $1,000 and your owner's equity goes up by $1,000. Now let's say that your business is doing great and you have earned $500. Your revenue goes up. So you credit your revenue and you collected the earnings in cash. So your cash goes up by $500. Now let's say you incur some expenses as you went along in order to earn your revenue. So you have to pay $100 in utilities. Although expenses is under owner's equity, which is on the right-hand side of the equation, your expenses actually go up. So you're going to debit this account by $100 and you're going to pay for it cash. So your cash goes down. You have to credit your cash by $100. Now you say that you decided that it's time to reward yourself, so you're going to declare some dividends and you're going to take out $100 from the profit that you have, which is the revenue minus the expenses will be $400. But you decide to only take out $200 because payments of dividends decrease the owner's equity. In the account, you actually put it as a debit because dividends go up and you pay for this dividend cash, so you credit your cash account. Now, if we sum it all up, you have $1,500 of cash that went up minus $300. Your cash balance is now $1,200. Your revenue is $500. Your expenses is $100. Your dividends is $200. Now, what is truly your owner's equity? Well, your owner's equity would be $1,000 contribution minus your $200 in your dividends and your net profit of $400. So let's say it actually went up by the $500 revenue, and then it was decreased by $100 increase in expense, and it was further decreased by the $200 dividends that you declared. So here you can clearly see that although dividends and expenses are in the right-hand side of the accounting equation under owner's equity, they by themselves get increased by debits. So if we sum it all up, you have $300 on this side, and the net would be a $1,200 credit balance. So the easiest way to remember these rules is by the expanded accounting equation. You have dividends plus expenses plus assets equals liabilities plus equity plus revenue. And if you put it all together, you can think of DEA equals LER. DEA are increased by debits and LER are increased by credits. So let's talk a little bit more about the T account. What is it really and where does it live? As I said earlier, it's truly just a graphical representation of an account. In reality, it doesn't really live anywhere. It is just a way of memorizing and remembering and keeping track of the debits and the credits. All of these accounts, all of the entries, all of the debits and all of the credits to these accounts are actually recorded first in the general journal, and then they all get transferred to the general ledger. Let's take a moment to review some definitions. We have the general journal, the general ledger, and the T account. The general journal is an accounting record used to record all journal entries chronologically. They then get transferred to the general ledger. The general ledger is a record of all past transactions and is organized by account. And the T account is a graphical representation of each account. Let's look at an example of how we can record transactions using T accounts, then list them in a general journal format, like a traditional journal entry. These would then be entered in the general ledger of each account. Your accounts receivable has a $500 balance from a previous sale. You receive a payment from a customer of $200. So you credit your accounts receivable for our pluses and minuses here. Your accounts receivable goes down by $200 collection, and your cash goes up by your $200 collection. Again, debits on the left, credits on the right. Now let's just record that in a general ledger format. So you put your date, let's say it was January 1st, 2023. Your other account is your accounts receivable. Debits on the left and credits on the right. You record your $200 cash collection, and your credit goes to your accounts receivable. So what you're truly doing here is you're using your T accounts to remember the rules, but then they all get recorded into a general ledger, which is a list of transactions in sequential order. You can see here where you recorded your cash, which was a debit, went to the ledger as a debit, and your credit in your accounts receivable was recorded on the second line. So let's look at an example of how you can use the T accounts to record all of your transactions and then transfer them to the general journal. Let's say you're a brand new blogger and you start your own blogging business. You invest $500 cash in your business. So your cash goes up by 500 and your owner's equity goes up by 500. Now we're going to label these because then you're going to have to be able to match them. So this is your first transaction. This will be number 1. You now need to purchase your laptop and it's going to cost you $1,000. So your equipment goes up for $1,000, but you do not pay for it. You take out a loan. So your loan payable account goes up for $1,000. And this is number 2. You now purchase a blogging course for $75. So your expenses go up $75. This is number 3. And your cash goes down $75. You now have to pay for hosting to host your website, which will cost you $20. So your expenses go up, number 4, for $20, and your cash goes down for $20. You take out a $5,000 loan to help you grow your business. Number 5, a $5,000 increase in your loan and your cash goes up by $5,000. Will be your number 5. You now finally earn ad revenue of $20. So number 6 will be your $20 go up in revenue and your cash goes up by $20. You pay your first installment on your computer loan for $100. So your cash goes down for $100, number 7, and your loan payable goes down for $100. That's number 7. You earned affiliate marketing income for $150. So transaction number 8, and your cash goes up. Number 8 for $150. And now that we have all of our transactions in our T accounts and we make sure that we debited and credited the correct account, we are now ready to transfer them all. And here you have it, the general journal. All of the transactions starting from the first one in a general journal listed in chronological order. And this is an example of a general ledger account. So in this case, I picked the cash account. So here you can see how the debits will go on the left, the credits on the right, and if we sum it all up, the balance of the account is a debit balance of $5,475. And that's it for today's video. I hope you now have a very good understanding of T accounts and how we can help you visualize and understand the debits and the credits. In reality, T accounts are not always used. It's really just a learning tool to help you understand debits and credits and the double entry system. I hope to see you in the next video where we're going to take a deep dive into the financial statements. I think we're going to start with the balance sheet. Thank you for watching. See you next time.